This is the S2G podcast. I'm Tanya Beckritzes. In this episode, we're looking beyond the 10-day forecast and taking a cross-sector approach to an urgent topic, weather. This podcast is for informational purposes only and should not be construed as legal, business, tax, or investment advice, nor should it be used to evaluate any investment or security. It is not directed at or intended for any current or prospective investor in any investment vehicle sponsored by S2G. Investing involves risk, including the potential loss of capital. References to specific companies are for illustrative and educational purposes only and do not represent an endorsement or investment recommendation. The views expressed by podcast guests are their own and do not necessarily reflect the views of S2G. For additional important information, please visit s2ginvestments.com/disclosures.
Across not just energy, but across a variety of industries, extreme weather is becoming a P&L line item, not a footnote.
What was once a topic mostly reserved for water cooler conversation has moved front and center in boardrooms, investor strategy sessions, and policy debates. In 2024, there were 27 individual weather and climate disasters that each caused at least $1 billion in damages, compared to just over 3 per year in the 1980s. Today, it feels like nowhere is immune, from heat waves in the Pacific Northwest to record-breaking snowstorms and flash floods in Texas, and derechos toppling crops and power lines in the Midwest. And it's not just the headline-grabbing events. Long-term patterns are shifting, with winters becoming warmer and drier, summers stretching into longer, more intense heat seasons, and hurricanes tracking further north. Beyond the immediate destruction, these changes ripple across industries and markets. It's why hedge funds are hiring more meteorologists and why companies across sectors are scrambling to protect assets, supply chains, and balance sheets from weather volatility. At S2G, we believe areas like weather are exactly where a cross-sector approach becomes critical. Agriculture, energy, and oceans each face unique risks, but there's a lot of overlap in the tools and solutions being deployed to meet these challenges. In this episode, Sanjeev Krishnan sits down with Bala Nagarajan from our energy team, Kate Danaher from our oceans team, and Cristina Rohr from our food and agriculture team to discuss how extreme weather and shifting patterns are shaping their industries, the most promising solutions emerging from their sectors, the role of AI in forecasting, and what the future of weather prediction might look like. So without further ado, here's Sanjeev.
Welcome to another episode of the S2G podcast. I'm really excited about this one. I have 3 great colleagues with me, Cristina, Kate, and Bala. Each represents different investment and industry vertical that we are in to talk about a topic that I think is literally near and dear to everyone's iPhone the first time they wake up, probably, which is the weather. I think what's interesting is when I was talking to a farmer of summer now, and I first asked him, what do you think of climate change? And he's like, oh, you mean the weather? And then earlier this year, I was talking to a trader at a very large trading firm and talking about power markets and what he was seeing. And he's like, I basically trade the weather. And so while the word climate can evoke polarizing perspectives in America and can evoke both anxiety and opportunity globally, I think weather obviously is a manifestation of the environmental physics of climate. And so you're here to talk about that across different industry verticals. So first of all, maybe just for the audience, we could have introductions. I'll go with you, Cristina, first.
I'm Cristina Rohr. I'm a managing director on the S2G investments team, and I co-lead our food and ag platform. And I agree, we see the impacts of weather day to day in a lot of the work that our portfolio companies are doing. So excited to unpack this more today.
Bala, I'm going to go to you next.
Sure. Bala Nagarajan, I co-lead our energy investments team. I think about this from a heating and cooling degree days perspective. I'm not ashamed of being an energy nerd.
All right. Last but not least, Kate.
I co-lead our oceans work, and we are the weather, so we think about it a lot. And this morning, I'm going to be in 3 different places in the next 10 days, so I was all over the weather app as I start packing my suitcases.
So we are focused on the weather, and I think one of the things that it perhaps people don't know, Kate, is the role of oceans and regulating the weather. Maybe just a bit of a one-on-one for folks on the importance of our oceans and how they regulate regional and global weather trends.
Some relatively well-known stats, but I'm going to say them anyway for folks who may not be aware. But our oceans cover 70% of the surface of our planet, and 90% of all excess heat ends up getting stored in the oceans. And 30% of all of our CO2 is absorbed by our ocean. So our ocean is a huge heat storage tank and a CO2 storage tank. And how the ocean really impacts weather, it's multifaceted, but one, it keeps our planet warm. So the majority of the radiation from the sun is absorbed by the ocean, particularly in tropical waters around the equator. And then the currents of our ocean move that heat all over the globe, essentially keeping climate in balance, at least the way that we have historically experienced regional weather. Also, I'd say that so much heat and CO2 is being absorbed by the oceans that it's actually changing the chemistry of the oceans. And that is changing water temperatures in certain regions. That's changing ecosystems, and the kind of cascading impacts of having the actual temperature of our oceans change has rippling effects across a number of different industries. And like the real impacts of a warming ocean are going to happen over generations, which is what I think really makes it challenging for the general population, or even challenging for the scientific community to hold up. Because in politics and our everyday life and looking at our weather app, we respond to the information we have in our hand. And when we look at the sky, we don't necessarily respond to something that happens over our and our children's generations. So scientifically derived statistics, but something that is hard to grasp when it happens over, again, like decades.
So one of the things that I want to explore, instead of doing this at a esoteric level, I want to go industry by industry. So ag, energy, and shipping. I think, Cristina, perhaps we could start with ag. How are extreme events rippling through commodity prices, yields, and talk about maybe the broader realm of food security?
Yeah, definitely. So when we look at ag, an important factor is that weather events do drive yield. So whether we're looking at heat, droughts, floods, all of these impact the ultimate productivity of the crops. So when we look at just the 2024 numbers, hurricanes and droughts cost over $20 billion in losses in crop and rangelands. So that's roughly 11% of the production value. And also, this is not an isolated year. When you look at claims, like insurance claims for crop losses since the 2000s, about 70% of those crop insurance payouts trace either to drought, heat, or excess moisture and floods. So those are very meaningful impacts that we see on the farm impacting the actual supply of grains. And this definitely, to your point, ripples to prices, right? So in 2012, when drought hit about 80% of the land, corn prices jumped 50% in a matter of weeks. So that was impacting everyone from the farm to the consumer. And also looking more globally, you see that weather in disease in West Africa sent cocoa prices to record highs. So you have roughly triple the prices from what was 20-year average. And this significantly squeezed the food margins globally. So we're definitely seeing an impact where droughts, floods, heat waves cause yields to fall, commodity prices surge, and as we've seen with cocoa and coffee recently, and food security weakens, particularly in vulnerable regions.
When you talk about extreme weather in the ag markets, how controversial is that to stakeholders?
I think the conversation is evolving from what is short-term resilience, designing the infrastructure, strengthening the supply chains in light of these disruptions. But I think there is also the conversation is more accepting of longer-term mitigation, right? How do we invest in sustainable systems, right? Like some of the farmers that we talk to are very interested in soil health and developing resilient soils that can withstand some of the weather disruptions. And that goes to a longer term mitigation outlook. So I think it's definitely a conversation that's evolving. And I think the question is, how can we invest in some of these sustainable systems that can provide a good mitigation to what is short-term acute disruptions?
And if you think about population density is one of the greatest drivers of political polarization globally, particularly in global democracies, this could be an area where the ag community and rural farmers could actually be a bridge building vehicle. And as an example, growing climate solutions passed, I think, the Senate with over 80 votes. It's clearly an area of political and cultural convexity. Bala, I'm going to come to you. It's the weather stupid, to borrow a James Carville term of it's the economy stupid. Power pricing, power demand, that price action, and how related to weather is it?
Yeah, I think we talk about you can't control weather, but you can forecast it, you can price it, you can hedge and optimize around it. What that means is you look at your phone, and if the temperature is 70 degrees Fahrenheit, it's a cooling degree day, which is you need to use energy to cool the buildings that we live in. And if it's 40 Fahrenheit, you mean it's a heating degree day, which is you're using potentially gas to heat the building. So every single day, weather impacts the quantum and in some cases the type of fuel you use in the energy markets, particularly in Europe, for instance, where much of the heating is done by gas. A heating degree day means that you're using more gas compared to a cooling degree day. But what has changed in the last 10 years or so is how weather has impacted supply. Much of the incremental capacity that we're adding to the grid today is wind and solar, which is obviously impacted by weather. A clear example of this is Ørsted, the Danish offshore wind developer, signaled to the market last week that because of lower wind speeds, they guided towards lower EBITDA. Similarly, in Europe last week, because of heat wave, the solar assets are actually outperforming because there is higher solar irradiance. And unfortunately, some of these solar projects are close to places which have seen wildfires, and these wildfire smokes actually dim the solar output. So the impact of weather is being felt day to day on the supply side as much as it is on the demand side, which is where the ability to forecast price, hedge, and optimize around weather changes has become super important.
The ability to predict weather, this power trader was like, it's basically a coin toss. You've looked at a lot of companies that try to predict the weather. Is it a coin toss? And there's also short term, which is like next day. And then here, long term is almost like next season because you can't go probably beyond that. But is Europe going to have a cool winter or a hot winter? Has huge implications, I assume, on natural gas.
I would think of weather prediction from a temporal and spatial resolution perspective. So temporal as in, can you capture micro weather phenomena without interpolation on a 15-minute interval? That's temporal. And spatial is people can get weather data on a 10 square kilometer radius easily, but downscaling that to a 100-meter resolution becomes incredibly hard. But that is needed if you had to predict weather at a turbine level or at a local sort of zip code level. So granularity, in my opinion, is the key to weather prediction. And the more granular you can get, the more you can go back to figure out what the mean error is like and where your models are potentially incorrect or correct, which enables you to trade around that with confidence. I think most traders today don't rely on a single model, whether it's the ECMWF or the Met forecast model. They bring together all these models, on top of that layer their own trading strategies. But when they get it wrong, they want to know where things have gone wrong. And therefore, then they down select on, did I get it wrong on a spatial level or did I get it wrong on a temporal level? And companies and service providers who can crack this at the temporal spatial levels are potentially likely to succeed.
The ocean sector and the soil sector are two biological systems, and it's the nature of biology. There's a ton of multivariance, nonlinearity, and complexity. So it's really hard to predict. Always, it depends. Energy, and push back on this, tended to be a physics system. Do you agree with that? And then two, does that still have a bearing, though, on as more and more renewables or other sort of factors come on scene, how much of it beyond renewables, let's just look at the fossil assets, are weather related events important to those assets?
Yeah, I agree with how you framed it. When you think about the legacy assets, I think about this in the context of gas, nuclear, and hydro. We touched on hydro, which is obviously impacted by weather. Nuclear, strangely enough, is also impacted by weather. The cooling water that comes out of a nuclear power plant needs to be at a particular temperature. Otherwise, you're not allowed to let that back into the river or the sea. So if you have hotter temperatures and hotter river and sea temperatures, then you're not allowed to sort of put that cooling water back, which means that you're paring back on nuclear reactor performance and output. Gas has similar constraints on cooling too. And more importantly, on gas, as the ambient temperature increases, the gas output also decreases marginally. Legacy assets are equally exposed. On the flip side, as trade routes in particular open up in the Arctic, then shipping routes on LNG from eastern part of Russia into Europe becomes easier potentially. And so lots of puts and takes on this, but interesting to see how these play out over the coming years.
Kate, maybe just talk about this from the shipping industry's perspective and what you're seeing in terms of weather patterns, current and changing, that are impacting that industry.
I believe that the consequences for trade routes is one of the biggest impacts on the shipping industry. For example, the Panama Canal, which we're all very familiar with, provides a vital shortcut between the Atlantic and the Pacific Oceans, which allows the ships to avoid lengthy, hazardous journeys around the southern tip of South America. Around 14,000 ships pass through the Panama Canal every year, and this accounts for about 5% of all global maritime trade. So it's a really critical trade route. And in 2023, they had a really sizable drought. Total rainfall was about 30% lower than average. As a result of that, the container ships that were passing through the Panama Canal had to wait days to be able to pass through because they could essentially only get one big ship through at a time. That slowed a lot of the trade, which cost time and money, and ships can end up missing their port slip. There's consequences to that. But I think a longer tail consequence is that as these companies realize that droughts in the Panama Canal are going to be an ongoing issue, it means that they're not going to be able to consistently get to places they need to be on time. And so they're starting to look at new trade routes, such as the Cape of Good Hope. But these alternative trade routes, we've been using the most efficient trade routes historically. And so new trade routes, while they may be more reliable, can drastically increase the length of time it takes for a ship to get from point A to point B. It can also have its own hazards, which a lot of companies and vessels aren't prepared for. And so from a climate perspective, from a cost perspective, and from just a business risk perspective, finding alternative trade routes that are not as well trodden as, say, the Panama Canal just adds more fuel, more time, and more risk to the businesses that are, doing global trade.
So I think if you look at statistics and facts, it's pretty clear to me that you have an urgent issue and an important issue. As we go from 1.6 to potentially 2.1 or 2.5, my sense is going to get worse in terms of the volatility. Where are you guys seeing innovative companies that can help companies adapt to changing and more extreme weather events that have been occurring for the last 5 or 10 years with increasing nonlinearity? And I'm going to start with you, Kate, just given the work you're doing on ocean intelligence and that linkage to potentially weather prediction.
Yeah, absolutely. Maybe I'll really focus on the data collection because, Bala, you probably have a few examples to give on how AI and everything is being applied to weather prediction. With artificial intelligence and machine learning and all these incredible capabilities that we're able to apply to the emerging technology and the models, I think that's really promising. But what is still critically important is the quality and the consistency and the repeatability of the data that you can collect to put into those models. And of course, we all know that NOAA, at least in the United States, has been one of the bigger data collectors and aggregators of weather data. And where that data goes and how it continues to be collected is, at least at this moment, an urgent question for the weather community. But what I think is less seen is that there are a lot of private sector businesses that are thinking about the collection and aggregation of oceanic and atmospheric data. One of S2G's earlier portfolio companies is a company called So Far Ocean Technologies. Today, I want to say they have about 2,500 buoys that float in the ocean. They're about $5,000. You could pick one up and throw it in the ocean. It's not something that's the size of a ship. And they collect salinity, wave height, temperature, a number of data points all the time. And that data gets aggregated. And they essentially have some of the most accurate real-time weather forecasting and can get pretty hyper-local with that forecasting, to Bala's point earlier about like situational awareness of the weather. And that gets fed into what currently is essentially a Waze app for the maritime industry to help them get really smart and real time about their routing for their vessels, but has a lot of other applications, everything from hyper local coastal prediction on weather events and major climate events to opportunities to actually inform larger weather pattern.
There's a saying, like, what happens in Vegas stays in Vegas. And there's a notion in weather is all weather is local. Is all weather local in the world, in the ocean intelligence world? I mean, are we going to see more structural stuff, or is it all, to Bala's point, which I think he may come to, which is all that downscaling, and how does it mean at the particular specific geography? Do you see that changing? That sort of weather gets a little bit more macro, if you will?
I think the answer is yes and no. I think it depends on the application. I think in order to sell a product to a coastal community or to a vessel owner who runs certain routes, you really do have to be able to downscale that. But I think what needs to get fed into a lot of these models that are then overlaying AI and machine learning, it has to be macro. So I think like the beauty of what SOFAR does is they can take all the publicly available like metadata and tie in their hyperlocal data to like downlink the big picture stuff to something that is more accurate on a more local basis. But we still need the macro to be able to inform broad weather patterns, for example, for agricultural applications. So in ocean, it's both and, I think.
Bala, what are you seeing on weather and innovation?
My perception from having looked at this sector is that across not just energy, but across a variety of industries, extreme weather is becoming a P&L line item, not a footnote. What I mean by that is whether you're H&M selling clothes or Nexera trading around power or shipping companies designing route patterns, you have to know the impact of weather on your products, on your infrastructure footprint, to figure out how to optimize your performance. And unfortunately, not every industry has the data science capabilities to take in the weather and downscale it and figure out how it's important for them or how it's relevant for them. So companies that can either build their own models or use external models, but more importantly, package it in a way that it's consumable for end customers, have seen significant traction in the last few years. I would say this is almost like cybersecurity. Nobody was buying cybersecurity risk premiums and insurance policies 5-10 years ago. People thought, I'm not going to get hacked. And then soon enough, not just the Fortune 50, but the Fortune 50 to 500 are getting hacked, and everybody's buying cybersecurity premiums. Similarly, I think weather data consumption is going to go up, weather data usage is going to go up, and more importantly, finding customized sort of data sets and insights that are applicable for each of those industries, that is resonating strongly. And I didn't come here to plug our portfolio companies, but strangely enough, we've got 3 portfolio companies that I would say are effectively masquerading as weather startups, Line Vision being one. Most utilities until recently were designing the transmission capacity based on static line rating, which is not dependent on weather, whereas the Utility Commission, FERC, the regulator in particular, said, you're done doing that. You've got to start thinking about using dynamic line rating, which is adjusting your capacity for actual weather conditions, which is what Line Vision does, using real-time data on air temperature, wind speed, cloud cover to then figure out how much capacity these transmission lines should carry. And that has a huge impact on how much additional capacity can be driven through our transmission lines. And then surety, most large corporates, when they sign power purchase agreements, are still buying megawatts, and these megawatts are not correlated to their end consumption. What I mean by this is Starbucks, in my opinion, should never be signing a wind power purchase agreement because most of their stores are closed at night, right? So they should be matching their real power needs, which is during the day, to ideally solar plus storage, which is, I'm sure Starbucks has gone in that direction. Similarly, for instance, Whole Foods, where if you're Whole Foods in Houston, much of your energy usage is cooling and refrigeration. And therefore, you should be thinking about, how do I add more power when cooling degree days, which is what we talked about before, where the temperature in Houston is above X, then I go add more megawatts. So I don't need to sign a static megawatt all across the year. Rishi has done a lot of work in this space around enabling corporates to buy flexible power rather than static. And I'm particularly excited about how to come up with newer creative power arrangements which will enable corporates in particular to maybe take weather risk but not operational risk, or the other way around. And the third investment that I wanted to plug here was Urbint. Urbint, as you know, provides software solutions to utilities, in particular helping utilities to prepare and respond better to storms, which, as Kate mentioned, the frequency of storms has gone up and the intensity of storms have gone up. And Urbint is seeing significant traction from utility customers who see the need to respond and prepare for these events.
Thanks, Bala. Cristina, so if you're trading the weather, there's no more real-world exposed trader than the farmer and sort of agriculture. What are the innovations that are occurring around weather in ag?
I think the ones that stand out are really precision and bringing resilience through localized forecasting. So what this means is there is an interest in improved predictability from the reactive damage control to proactive, more yield optimization. And some of the companies that we see that could be very helpful in terms of helping farmers make informed decisions are the ones that combine AI weather models with IoT proprietary data, as we talked about earlier. An example of that is one of the companies in our portfolio, Arable. They actually have a public partnership with Google, and what that partnership entails is that they leverage Arable's crop intelligence platform to deliver real-time data on weather, soil moisture, and crop health. And that's used for optimized irrigation and decision-making. The partnership has the stated goal of saving somewhere around 2 billion liters of water, which is meaningful in certain basins, while enhancing productivity amid some of the droughts or other weather events. So we're very excited about a lot of the advancements that we've seen, the ability to provide hyper-localized data to make better decisions for farmers.
You can't start a podcast or end a podcast or anything between these days without the noun, verb, adjective of AI. It is topical and cliched at this point, but I think it's obviously also an important secular trend. Maybe, Bala, I want to start with you first. So you and I have actually probably had some debates about this, and who knows is sort of the end game here. But if we believe that AI is electricity tokenization to productivity, if you believe that is actually going to happen, you're certainly going to need a lot more electricity and power. I guess, given solar storage, wind, but also, I guess, emerging sort of focus on natural gas, how will this play on the weather side? Do you see any systemic impact, particularly around natural gas, I would imagine? But
I would say that, let's use the example of solar. In many markets, solar is quote unquote over-penetrated. There are people building more and more solar projects in Texas. Texas doesn't need solar projects. And sure, you can shape the curve using storage. But at some point in time, you're dumping more solar into a market that doesn't need it. And given that electricity is such a localized market, unlike oil or potentially gas, which can be stored and shipped across nations, higher solar irradiance or higher build out of solar, for instance, in Texas, the most productive way to consume that, to follow your point, is by building localized data centers. Are you bringing the load to the generation rather than the other way around? And so to a large extent, if you're going through a period of higher solar irradiance and in markets which are easy to build but very hard to consume energy, then AI could be a localized solution to that phenomenon.
But Kate and Cristina, weather is a hard thing to predict. It's a complex adaptive system, there's a ton of nonlinearity, easy to causate. But do you all think that better machine intelligence will lead to better prediction for shipping industries or for agriculture?
I'll start. I think over time, yes. When it comes to weather forecasting and AI and machine learning in my world, so when you think about what some customers care about, of course, they care about the 3 to 7 day forecast and what they can plan on for the next few days. But the insurance industry, the shipping industry, probably farmers, Christina, I imagine, like people are really interested in seasonal or year long, like what's going to happen in 3 months, or when is an unprecedented climate event going to impact my business? That's still, I think, where AI and machine learning is having a hard time really adding value. So right now, AI is really good at the hyper local and timely forecasts, the models. The data that's going into the models is training some good outcomes on a short term, but it still relies on good data and it still relies on accurate data. And the AI modeling doesn't quite know what to do or how to predict extreme unforeseen events because it either wasn't in the model or it influenced the model in the wrong way. It also, longer term weather forecasting integrates physical based models, and AI hasn't quite yet figured out how to bring that in. So in the world that I live in, I think there's a lot of hope and excitement around it, but it hasn't broken through yet to really help us prepare for some of the longer term things that industries like insurance and the problems they care about solving or anticipating.
Yeah, I would resonate with a lot of the things you said, Kate. And I think in ag, outside of just understanding specific crop productivity yields, yearly yield scenarios, and how to respond to weather events, it's also important to understand the crop's adaptability over the long term. I think we're seeing in certain cases where certain crops are not fit to grow in certain regions. There is a lot of concern and thought process being done to understand how crop adaptability can be increased, whether through genetics. There's obviously drought, heat tolerant, short cycle, late maturing varieties, pest disease, all of those genetics come into play. But I think in terms of having a reliable weather forecast to dictate which crops are more viable at granular level, I think that the data is still not quite there yet.
Okay, I'm going to go back to you. Are there any private sector groups trying to figure out the next generation of weather, or is this largely in the domain of the public sector?
No, I think some people are trying to figure it out. I mean, Bala, I don't know if you would agree that Mediamatics is trying to figure this out. Brightband, Tomorrow.io, they're all using multiple data sets, ocean data, balloon data, space data, and then overlaying it with AI machine learning to try and predict better, hyperlocal, more timely weather events. So I think a lot of people are trying to figure it out. And I think it's actually quite a competitive space at the moment. Yeah.
Can I jump into the question? Kate,
Yeah,
do you think oceans has impact on near-term weather, or is only mostly long-term weather? And the reason I ask this question is, if you're an energy trading firm, you can't take a long-term bet on how energy markets would perform given changes in weather, but you need to backcast and make sure that actually holds good over many years from a model perspective before you can go place meaningful amounts of money and bet on those sort of continuing. I've not seen too many people put real money behind taking long dated views on energy markets on the back of seasonal changes, if not multi-year changes coming out of changes in ocean temperature or weather patterns. So what's your view on near-term versus long-term impact on weather from oceans?
I think you're right, Bala. I think that, and to Sanjeev's question, so in our ocean intelligence portfolio, which is a lot of data collection, the biggest customer, these are all very much dual use technologies, and the dual use is mainly by governments. So the Navy, NOAA, and other countries, they're similar departments. And they do have a very strong interest in the long-term collection and activity of what's happening in the ocean. We haven't seen that much interest yet from the private sector in taking that long view. They're interested in the widgets and the tools and the productization that can come out of those big data sets, but they haven't yet gotten really interested in the actual investing in the collection of the long-term data sets.
I do think things like
Not yet.
the private sector version, Kate, of the Argo network, or there is opportunity if you have a view. Commodity firms, some of their biggest FTE costs is weather people that they hire to try to figure out some ARB. But they're not going at it, I would argue, the first principles, which is really around this ocean intelligence and where do you cluster station keeping assets that can actually measure it and then predict.
Yeah.
And I agree.
I think
it's 6 months forward or 9 months forward, I imagine, Kate.
Yeah. And I do think it will change. I think it will change over the next 5 to 7 years in terms of corporations taking an interest in that data. There's many companies that are like early stage companies that are collecting this data. They see the need for the pervasive station keeping, consistent detailed data collection. But our thesis going into investing in a lot of those companies is there's going to be a private sector opportunity here. And that private sector opportunity has just taken longer to get to because the opportunity is not obvious to them yet. But I think the veil is being lifted relatively quickly.
If you were thinking about explaining sort of the weather volatility, and we'll end with this, kind of what is the thing that would change your sector in terms of if you had a predictability, and what are the opportunities to work cross-sectorally to both assess the new beta, but also the alpha? And I'm going to start maybe, Cristina, with you, just around what sort of the cross-sectoral opportunity here and what would better weather mean to the sort of the economic value of agriculture.
Yeah, and I think as you pointed out, Sanjeev, I think weather is becoming a new investment factor. And we are in a situation where these extreme weather events or shifting climate patterns are influencing earnings, asset values, and supply chains. I think that from an alpha generating perspective, if you're able to anticipate and hedge, that could be a tremendous opportunity. At the same time, it also complicates the beta because it makes the broad portfolios more volatile, right? So we see how weather shocks ripple across multiple classes or across all of our industries at once. So obviously, with the example of a single hurricane, we can have energy outages, we can have crop losses in ag, and I'm sure, Kate, with shipping and ports are significantly impacted, and this raises correlations, I assume, significantly. It does point to the fact that I think winners would be those who treat weather almost like interest rates or foreign exchange. You measure it, you manage it, and then you use it as a source of your advantage.
Thanks, Cristina. Bala, same question.
I'm particularly bullish on parametric insurance. Traditional insurance has never been good at covering short duration interruption and has notoriously long payout timelines. With the advancement in collection of data and the ability to use IoT/sensors and devices, business interruption risk in particular around weather, whether that's hurricanes hitting the coast of Florida and pizza chains not selling any or Uber Eats not delivering, those can be solved fairly quickly, rapidly, and with high sort of integrity around available data and not be subject to claims and whatnot. So I know companies that are trying out parametric insurance around if the wind speed is above 100 miles an hour, I'll pay you out. It doesn't matter what you do, whether you're on holiday somewhere else or here. There's another company that is selling parametric insurance alongside booking any kind of event-driven holiday, whether it's you going on your ski season break or attending Coachella. If it rains, you get your money back 2 days before you even think about heading to Coachella. I think the ability to integrate weather data, and which is where collection of data becomes super important, and building models which will enable insurers to underwrite these models better, and then having a direct-to-consumer, if not B2B offering that gets this in front of large customers, large suites of customers. Few people trying it, but I'm particularly bullish with the advancements in technology. We'd be able to get this right.
It'll probably make us pay for turbulent flights and then turbulent flights.
That's evil. That's evil.
All right, Kate, we started with ocean and the regulated weather. We're going to end with that. What are your thoughts on the same question?
I'm going to take a slightly different tack to it because it's parametric insurance, and the insurance market is something that I'm also really interested in. So I won't repeat everything that Bala just said, but I'll plus up to that, I think, and being somebody who spends a lot of time in the ocean intelligence world and just understanding how important the raw data is, I think that if we can demonstrate value to the insurance industry, if parametric insurance can get better, then that's just going to drive upstream more opportunity to become better at measuring the ocean and pulling that data. But I think one of the things that I've found interesting related to the insurance industry is the potential for natural capital to mean something in the private sector and in the markets. Last New York Climate Week, I was at an event for the Ocean Risk Resilience Alliance Association. It's mostly a group of insurers who are thinking about vessel owners and asset owners, thinking about how ocean risk and resilience impacts markets. And there was a group of insurers talking about parametric insurance, and they said that in 2023, they had a number of hotels who were able to value the health of their coral reefs off their coast, and they actually were able to reduce the premiums they had to pay to their insurance companies because the insurance companies saw that those reefs actually were going to help weather major weather surges, like wave surges. So I think it's interesting that we're even starting to price natural capital and the health of natural assets into insurance.
Yeah, I think it's the maturing of the weather derivatives market, which I think is going to get more sophisticated and more interesting for many. I really want to thank all three of you for joining. Hopefully all of you have a great, instead of Climate Week, we call it the Weather Week. Well, the weather in New York is my favorite in the autumn. So hopefully all of you have a great and productive week in New York. And thank you, Cristina, Kate, and Bala for joining.
Thank you.
Thanks, Sanjeev.
Thank you for tuning in to the S2G podcast. If you enjoyed this episode, please subscribe, leave us a review, or share it with a friend. For more information or to connect with us, check out s2ginvestments.com.